Hey, welcome to the Blue Sky Business Acquisitions Podcast, everybody. This is our episode 2, and our topic is Sellers Maximize Your Value. This episode is brought to us by Squash CPA, a due diligence firm. Smart deals start with solid numbers. Squash CPA offers next generation of quality of earnings and due diligence to help you navigate your deal confidently. Get started at squashcpa.com. Dave, we appreciate your sponsorship. And just some quick introductions here before we jump right into our topic of the day. My name is Matthew Brazel, Finance Director for Sunbelt Business Advisors out of Milwaukee.
Hey, this is Tom Flanagan. I'm a business broker at Sunbelt Business Advisors. Excited to be here.
I'm Ben Woodward. I focus on SBA lending, 20 years in the business, primarily focused on business acquisitions.
Wonderful. Thanks, guys. And without further ado, I'd like to introduce a masterclass in M&A. Our co-host for the day, Ed Krajcir. Ed, could you please tell us a little bit about yourself and what you bring to the table today?
Oh, terrific. Thanks, Matt, and Tom, and Ben. Great to see you again as well. Happy to be here and discuss this. I have had the fortunate opportunity in my career to be doing this for over 20 years. I've worked with many business owners. Prior to that, who's in first grade saying, I want to grow up and be a business broker? I don't think there's too many people that are picking that path, or SBA lender to be that specific as well. But no, I grew up in Wisconsin, went to the University of Wisconsin-Madison, started actually in the construction industry. That's where my degree was in from Madison. I worked for a pipeline distribution company in Washington, D.C., Minnesota, Eastern Europe, and China. Then worked for a construction equipment manufacturer, the OEM, and then a VP of sales. Always had that entrepreneurial spirit, wanted to get into owning my own business, was looking for businesses to buy, and I saw a need in the market for a firm like ours. And over 20 years ago, started the firm. We've continued to grow. Absolutely honored to be working with Matt and Tom and the rest of our team. But thanks again for inviting me to the podcast today.
No, absolutely. And
Excited
thanks
to
for,
have you.
excited to have you. Thanks for taking the time. Ed, maximizing sellers' value is one of the things that, we as brokers come across on a daily basis. What do I need to do? How do I need to do it? And what better person to take us down that pathway than our managing broker, right? And leader here in the office. So I guess, Ed, take us down the pathway of what you like to see when a small business comes to market versus maybe a large business. What are some things a client can do right now today in the next 3 to 6 months to maximize their value here in 2025?
Sure thing. So let's break that down. You said small business, large business. Let's focus on the small business side. What does that mean? We're looking at transactions that'll take place under 5 million. That's in the wheelhouse where the SBA does SBA guaranteed lending and Ben is lending on. So we'll focus in that area. Well, having time to prepare for the sale is great. Talking to a business owner 2-3 years out, we can help them. But let's say, hey, I want to take this business to market sometime in 2025. What is one of the things I can do? Well, let's look at financials. Cleaning up your books. Most small business owners for years have run their business to minimize profit. A statistic that came out in this past year from the SBA, the Small Business Administration, 65% of small businesses are profitable. That means 35% are not. Now, does that mean they're all actually losing money? Well, maybe some are, but small business owners try to minimize that net income. Why? They pay taxes on. How do they do that? Well, there's a lot of expenses. They call discretionaries. They might run vehicles. They might run insurance. All different types of expenses they run through the business. If you're intent on going to market in the near future and you say, what can I do first to maximize my value? Let's clean up your books. Let's see if we can see where these expenses have been expensed. Let's look at what we call seller's discretionary cash flow, another term, seller's discretionary earnings. That's where Ben and his team is going to look at this and say, okay, what industry is this business and what value can this discretionary cash flow support? If we can't see that and follow it, buyers aren't going to be interested in the business, or if they are, they're going to pay a lower value. And then when it gets over to Ben for financing, then they're going to take a look at it and say, hey, I cannot see where all these numbers are adding up. So getting in there, working with your accountant, bringing that up with your accountant the year before you want to sell, 2 years before you want to sell. Let them start working with you, cleaning up your financials, a set of clean books. We'll shift your multiple up. It might make your business sellable. Without clean books, it might not even be sellable.
No, and that makes, a lot of sense. Cash flow in a lot of scenarios is king, as Ben, you would, like to see when a deal comes to your plate, it's got a cash flow, right? Um, when we think about maximizing the value outside of the financials, Ed, what are some operational things a seller can focus on?
Sure. Well, outside of financials, some of these things take a little bit more time. So maybe if you're a business owner, you're saying, hey, I want to exit in 2028. Well, why are they picking that date? Maybe that's the time that they go on Medicare. And everybody knows the cost of health insurance. So many small business owners say, hey, that's when I want to sell the business. I can go off my insurance. I can go on Medicare. So if you want to sell in 2028, you should probably be taking a look at going to market 10 to 12 months before your target date. What else can we do? Let's look at operations, processes, and systems. Many small businesses, many successful small businesses, everything is in the owner's head. They might have all the contacts with the vendors. They might have all the contacts with the customers and the clients, and they take that on and they really enjoy that. That's the passion that drives them in their business. But the processes and systems, from the time that the order comes in till it's produced or the service is provided, how does that work? Putting in processes and systems, one, makes it easier to sell. If you got to transition this business to a buyer, what does that look like? If you have to download everything up here and teach them, it's going to take a lot longer. But if you have that documented, work with your team. Start on the operations side and say, okay, let's document your processes and systems. How many business owners, guys, all of you, do you hear, I can't find people? And when you do, it's so hard, you got to train them and you want to stay. Well, part of that is training them efficiently and quickly, costs less, which means more cash flow, which means more value to the business, and being able to replicate that. So you work with your operations team. Let's put in processes and systems from when an order comes in to when it goes out the door. Work on the financial side. If you don't have a controller, maybe it's your bookkeeper, maybe it's your accountant. Say, how do I clean up these financials? How do we run it through the books so that we can track the inventory properly? That's another area. Inventory. Do you have obsolete inventory? Ben and the bank, they're not going to finance obsolete inventory. The buyer, they're probably not going to pay for the obsolete inventory. So let's clear that out. What does that mean? Maybe it means reducing the price on it to sell it, or maybe it's scrap, whatever. Move it out. On the financial side, maybe you're well heeled, so you don't as doing well as a business, so you can carry 90-day aging or receivables. Well, a buyer, that's going to be important to get that in current in 30 days, 45 days. So start getting your customers accustomed to paying you sooner, following up, getting that AR current or 45 days. Cash is king for everybody, but especially a new buyer. So, they're going to ask for, hey, give us an aging report. Well, 90 to 120 days, we're not even going to count those. The seller, the business owner, oh yeah, I've been working with Charlie, always pays like that. Well, get Charlie to pay a little bit sooner. I mean, these are some of the other areas, like in the operation space, that you can refine to make the business more attractive to the buyers and the banks.
So that actually brings something to mind. You mentioned receivables and Charlie, right? Charlie's a solid relationship. He sounds like a buddy. But what about like contracts? I mean, we've all seen transactions where contracts come into play. Are they transferable or are they assignable? What are your thoughts on that? And how should a seller maybe legally prepare to transfer and maximize their value?
Well, when you're getting ready to sell, depending on the types of businesses, some businesses have a lot of contracts. If they're providing to, OEMs, if they're providing to big box stores, they probably have contracts. Get with your attorney. And if you don't have an attorney, reach out to us. We work with a lot of really good attorneys that understand how these small businesses sell. Get those contracts in line. They might be contracts, internal contracts with key people. They might be contracts with vendors. Let's say you're your distributor. Well, what do those contracts look like? Do you have an exclusive territory or not? It could be contracts with the customers. Now, if you're dealing with the big companies, they're the ones that are giving you the contract. And you have to work with that. But work with your attorney. We've had situations where you ask the sellers to do that. The time that you don't want to be dealing with this is when you're in due diligence and the buyer's asking for these contracts, and oh boy, this one isn't assignable. Geez, we got to go back to them. Well, now all of a sudden they see it as an opportunity to renegotiate with you. And all these little issues can happen. So get these contracts in line ahead of time before you go to market. And again, we offer our services as a huge resource ahead of time. Helping business owners connect with the advisors that they need. A business owner, if they plan for exit, 12, 18, 24 months ahead of time, they might be able to get 50, 75% more for that business just by moving the needle in a few areas.
Ed, can you talk about some more of the advisors that the seller should approach within that time frame? Like you said, if it's 12 to 18 months or 3 years from now, who should they be reaching out to and connecting with to put them into the best position they can when it comes time to go to market?
Sure thing, Tom. Well, they should start one with their financial advisor or their estate planning attorney, whoever has been working with them to put their affairs in order. The financial advisor, they're saying, hey, I want to retire. I still want to go down to Florida in the wintertime. I want to play golf. These are going to be my expenses. So let's take a look at what you're going to need to do that. And hopefully they've been planning for this all along, but you definitely want to plan for it before you go to market, because you don't want to find out while you're out to market, I'm not getting enough money for this business. I got to, everything in life is risk. You as a business owner, when you start the business, there's a risk to it. Running the business, there's a risk to it. Selling a business, there's a risk to that. You want to maintain confidentiality. And that's something that we really focus on when we work with our business owners. But you don't want to just go to market for the sake of going to market, because if your customers found out, your vendors found out, your employees found out, these can have negative impacts on the business. So I would start with the financial planner, and that's where we also come in on the front end, or the estate planning attorney. What is my business worth? You got all these other assets. Maybe you have rental income. Maybe you have, stocks, bonds, IRAs. But what is this one asset worth that I've put all my blood, sweat, and tears into? It's probably worth 70% of your net worth. That's where you can come in and say, hey, right now this business could sell for this range. And then you sit down with your advisor and they say, hey, we're on track. We're good to go. I think we can go to market. Or your advisor might say, hey, you can sell in this range. You really need to be somewhere up here if you want to live the lifestyle that you've told me about. Well, that doesn't mean that you got to work for 5 more years. Like Matt had asked about before with the financials. That's some low-hanging fruit. Let's clean up the financials. Let's put in some processes and systems. Perfect example. Let's say you have a business that sells for somewhere between a 3 and a 5 multiple. Let's say your EBITDA on that business or seller discretionary earnings is $750,000. You have large customer concentration, 30% with one customer, 20% with another. So 2 customers are half your revenue. That's a risk. That's going to push your multiple down, your value down. Your financials, it's hard to follow and see where all the expenses are. That's going to push it down. Operations, processes, and systems. You're the guy, you're the gal. You're going to have to teach that buyer. Well, what if you were able to put processes and systems in place where your team can teach the buyer and they can onboard people? These are all some of the things that you got to look at. Management team as well. Can they take over? Can you go to Florida for a month or 2 and they run the business? Or are you nervous to leave for a couple of days? You can answer the question yourself as the business owner. So you take a look at these things. Let's say you're doing 750 in discretionary earnings. Let's say all these negative things we just talked about. You're more in the 3-ish range instead of a 4 or 5. Well, let's say you just clean up the financials and you put in some processes and systems. The processes and systems make you a little bit more profitable. Cleaning up the financials lets you see the profitability of the business that might have already been there. Let's say you take that cash flow from 750 to 900. And let's say you were a 3 multiple before. 3 times 750 is 2.25 million. Well, maybe you move that multiple up just to a 375 because you put processes and systems in place and you have cleaner books. 900 times 3.75, that's almost that's 3.3, $3.4 million. That's a 50% increase in the value of the business because you moved your multiple and you moved your cash flow. And you didn't move them a lot. You went from 3 to 375 and you went from 750 to 900. That's possible. That's possible with most businesses if they get the right advisors in place and they work to fix these issues.
No, that makes a lot of sense, Ed. And I want to switch gears here just a little bit and talk about like seller's mental state. Time over again, this is their baby. They've owned this company for 30 years. Walk us through maybe some ebbs and flows of the sales process as far as the seller's mental state, right? Because they could either be ready to sell or not ready to sell, but they feel they need to sell, but maybe they don't. We were talking earlier today about a client that put about a $600,000 piece of machinery in 2 days or so before they're ready to list the business. I mean, walk us kind of through that, right? Because you have to run the business while you're listed, but you also have to be in the mental state to sell the business.
Well, let's start with that piece, the mental state. I mean, that's critical. And we'll take on about 1 in 4 businesses that we talk to. And a lot of the times, they're just having a frustrating point in that time in the business and they contact us about selling, but they're not really mentally ready to give up. That's not a business you want to take to market. Other situations is false expectations on value. I mean, that's something that, I want $2 million for the business. Why? Well, I paid $1 million for it. I want to pay off the condo mortgage in Florida. I want to, get a couple of these toys and I want to have some extra spending money. So I think it's worth about $2 million. Great. Ben's going to look at it and say, they'll value the business. We'll value the business. It's really only worth about 1.2 to 1.4. So what the owner wants is not necessarily what the market will provide for the value of the business. Okay. So one, emotionally and mentally, you got to be prepared to sell. It's also going to be a very stressful process. You mentioned this is their baby. Maybe they put the last 20, 30 years of their life into this. Next to death or divorce, selling a business can be one of the most stressful things that an individual goes through. And we have a saying in the business, every deal dies 3 times. Either the seller's walking away from the table, the buyer's walking away from the table, the bank's walking away from the table. Somebody's walking away from the table and being able to put that back together. Well, why did the bank walk away? Well, maybe it's a industry that particular bank doesn't want to lend in. We got to find that out. Why did the buyer walk away? Well, they're nervous too. This is very stressful for the buyer. They're putting personal guarantees. They're putting all their assets up in many cases. So this is something that the buyer's looking at, but from a seller's perspective, again, you got to make sure you're ready to go through this process. And it's not a quick process. This isn't over in 2 or 3 months. I mean, you got to put together the marketing package, you go to market. Then you got to cast the net to as many buyers as you can, maybe strategic buyers, maybe individuals. Then you write the offer or the letter of intent. That might take, hopefully you got 2 or 3 of those that you're working at the same time. Then you get the accepted offer or the accepted letter of intent. Then we start putting the package together, helping the buyer do that, taking it to Ben, for example, to put through underwriting. From the time you get that accepted offer to closing, it might be 75 to 90 days. Now there's real estate involved. Now it might be 90 to 120 days. So you're talking about 3 to 4 months possibly after you get the accepted offer. So you have to be mentally prepared for that. You got to be prepared for, hey, the buyer might back out for this reason or that. And then we got to go back out to market again and find another buyer. So that's some of the stress. We try to prepare our sellers before we go to market so that they know. But there's a lot of times where it's very, very frustrating this process. We do everything we can to try to make it as smooth as possible, but you are selling possibly your baby that you put the last 30 years of your life into.
No, it's understandable. And so, Ed, why don't you walk us through the reality of cash sales? I mean, so many sellers come to the table and say, I want to sell, and it's going to all be cash, right? But we know that that's probably not going to happen. So, I guess walk us through the mental state around industry saying, I got a cash buyer.
Okay, so by cash buyer, are you referring to somebody that's bringing 100% of their own money to the table to buy the business?
Exactly. Yes.
Okay. Most buyers won't do that. And here's why. If your business is selling for $1 million and they have $1 million in cash, they're probably buying a $4 or $5 million business. They're putting 20% down. They could be buying even a little bit larger business than that, but somewhere buyers are typically bringing 10 to 20% to the table. Okay. And then there's a bank involved. And banking, Matt, as our finance director, and Ben, boy, that's changed over the last 18 to 24 months. We were back at 6% interest rates on SBA loans. Then we went up as high as 11.5. Now it's come down a little bit, but there's a lot of things that go into play in getting this deal done. The other piece of the puzzle is seller financing. All cash, it sounds great. Most business owners, they'll be on the golf course, they'll be out fishing, they'll be at the club or wherever, talking to one of their buddies that sold a business and did seller financing and might have gotten burned along the way. Don't do it. It's bad. In today's environment, if you're not seller financing, you're really limiting the pool of buyers that could potentially buy your business. And you're limiting the value too, because price and terms is like this. If you're willing to seller finance, you're taking on some risk, so you're going to get rewarded for that. And you'll also probably get some interest on that money. And we're talking 5-10% in most of these smaller transactions that a business owner's carrying, maybe 15%. But saying, I want a buyer that's going to bring all their own cash, that's a unicorn. I mean, has it happened? Yes. We've sold businesses where they were well heeled. They wanted to invest the money into it rather than getting a loan, but that's highly unusual. Most buyers go to somebody like Ben and put together a loan to finance a portion of the transaction, leveraging their money. Everybody's heard that word, leverage. So by putting 10% down or 20% down on a business and financing 80% and maybe 70% with the bank and 10% with the seller, they're letting the business pay that off. Plus, they have their own salary on top of it. And that's something that you, as our finance director, you're working with sellers ahead of time to say, hey, this is the max we can finance your business to. And that's why when we take deals to Ben, it's teed up because, hey, we got an offer in place. We know it can finance at this number. And then Ben can put together the package and take it to their underwriting. But yeah, wanting that is one, limiting yourself to a very small pool of buyers and possibly never selling your business if you're saying, I'm only going to sell to somebody that's willing to bring all cash and not go through a bank.
Right. Yeah. I mean, it's such a small window of people that's out there, right? And we were talking earlier, Ed, you had given us some examples of sellers that went through a proper plan. They made the decision later in life that I'm going to retire, and then they got put on a path. And then eventually they exited, right? Why don't you share with the team and the listeners out there some of those examples of sellers that went through the process the right way and were able to maximize the value?
Well, back about 4 or 5 years ago, we had a business owner approach us. Two very successful businesses, but they were run on one tax return. See Ben almost cringing now. Oh, geez.
And
The other
for the
part of the
listeners,
problem was,
yeah, the listeners out there, that's called a divisional sale. Ben, if you want to chime in here, what that looks like, but basically, we're two entities, two divisions within a business roll up into one tax return. While you can make that happen, it's incredibly difficult to sell them both off.
Yeah, if you've got two entities that are consolidating into one tax return, you have to be able to separate the revenue and the expenses of both companies, and you have to be able to prove it. So uh, that can be done through a variety of ways. One of which is sales tax receipts from the state, uh, but it can be a difficult process. So it's a hurdle to overcome, and if you don't have the right reporting, it a lot of times will make the deal ineligible. So you have to
Mhm.
really, we're getting into the granular details, right, of like a unique transaction, uh, but yeah, that creates a problem.
It does. And the word ineligible, what does that mean, Mr. Seller? SBA cannot finance it. So that means maybe you got to go conventional, which means the buyer has to bring a lot more than 10 or 20% to the table. And they may discount the value of that business. So we sat down with these two business owners. They decided at the end of the year, they're going to create two LLCs. They were going to separate everything. And then forensically had an accountant come in before we went to market. And they already had these like in two different classes and how they were booking it in their financials. And then we had a complete year of each. We sold one of them. That one sold for 7 figures. And then the following year, we sold the second one, and that one sold for 8 figures. So listening to the advisors, because the two buyers for those different divisions were different types of buyers. It made a lot of sense on how they were running the business, but splitting it out made a lot of sense. Another situation, a friend of ours had a particular business, and over a period of about 4 or 5 years, talked to them about different stages and things they could do. They had their cash flow, which was south of $1 million, or their EBITDA was at the time. Made changes, and the value of the business that we had was X, we'll say. We talked about all the different types of changes they could do and the growth they did. They went out and bought another company, they added it to it, and then they took their EBITDA up threefold. It was in the 7 figures. They literally got close to a 10 difference in what that business sold for compared to what they were originally worth. Now, they got lucky because their industry had a roll up at the time, and lots of private equities were coming into the industry and paying a premium, but they built a business that their sales went up 4-fold in top line revenue, and their
Wow.
EBITDA went up about 4-fold.
Ed, so from what you're saying, I mean, and this has been tremendously valuable. I think listeners are going to love this, but I mean, so from the start, getting with the deal team, getting with a broker, optimizing financials, operations, etc. Talk about, once you go to market, maybe with a broker, how do brokers maximize value once you're listed, right? Because there's all that upfront, work that may need to be done, but post listing, talk about how we really can bring the most value to that seller
Sure.
once we're to market.
Well, the first thing we do before we even take it to market, we put together an opinion of value and we sit down and we talk to them. And let's say everything's aligned with their goals, what they want to do, mentally they're ready, it's time to go.
Mm-hmm.
When we put together that opinion of value, it's called normalizing or recasting their financials. We're trying to identify, their EBITDA. What is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. So earnings is their net income, the depreciation, the interest, the amortization gets added back. But then we're also identifying some of these other expenses that were in there that we're calling discretionary. Put that together. Then you put together the package. And then what you try to do is find potential strategic buyers for the business. Strategic buyers can pay a little bit more. Why? They're called strategic for a reason, because there's synergies that those businesses have that can take your existing cash flow and make it greater. So that's one thing that, as brokers, whether it's us or another brokerage firm out there, cast the net out to those strategics. In our situation, we have 3 proprietary websites that we post on that nobody else can be on, through Sunbelt Network or Sunbelt WIN or Sunbelt Midwest. Then we have thousands of people on our database that over the years have looked at businesses actively, probably about 4,000 or 5,000 active buyers that have been signing NDAs. We reach out to them. Everything's in confidence. It's confidential until they've signed an NDA. And then while we're doing that, we're also helping set the expectations of the seller. Okay, here's where we are. We're going to go to market. This is what to expect. And then while we're out to market, the market tells us things. And if you're good at doing this, you're sharing that information with the seller, and you might even be adjusting your SIM. That's the confidential information memorandum or confidential business profile. You're making changes along the way. This is a fluid thing.
So, and I don't mean to interrupt, but so you mentioned it's all confidential. There's a teaser and NDA signed, for a buyer prior to getting that SIM or CBP. How does that confidentiality help, the process for the seller, the buyer, et cetera? I mean,
for sure. So one, we tell business, I'm not so concerned about confidentiality. Well, how hard is it to find employees? It's really hard to find employees. Well, do you want to scare them? Because
right.
When an employee finds out a business is for sale, everybody thinks the worst. They're not thinking, hey, the boss just wants to retire like everybody else does when they get to that point in time. They're thinking, what's wrong with the business? And everybody thinks about the movies. Oh, the buyer comes in and fires everybody. Well, that's the most asinine thing because the buyer needs all those employees. So that's why confidentiality is probably the most critical, is to maintain that confidentiality from the employees, plus customers. Let's say you're a machine shop and you bid on projects. The customer finds out you're for sale. They might go with the second guy, even if they're a little bit higher, because they know they're going to be around to get it done. Vendors, geez, there must be something wrong with it. Let's tighten the terms. These are all the negative things that can happen to a business when you're marketing it and you don't do it confidentially.
Yeah, and Tom, you actually bring up a pretty good point here is the process that goes into listing, marketing, and eventually selling a company. And Ed, you and I talked earlier during our pre-interview about like deal killers. And I mean, we've seen it, right? Where a seller does all the right stuff on the forefront. They write their financial books. They put operations in place. They clean up inventory. Maybe they diversify their concentrations in customers. But then we get an accepted LOI. Now we're in diligence and we're moving down and we're working with bankers to get a commitment letter. Give us, I guess, walk us through some reasons over the last 20 years that you've seen deals fall apart post acceptance, because we all know that just because you got an acceptance doesn't mean it's going to get it to the finish line. And I think that that's the picture perfect methodology, is to grow your business, list your business, and then sell your business. So walk us through some deal killers that are out there.
Sure. Communication is probably one of the biggest deal killers. You're not communicating as the business owner to your broker and your other advisors what you're doing. And the last thing that Ben as a banker wants to see, or us as brokers and buyers, are surprises. Oh yeah, I forgot to tell you that customer left last month. If we know on the front end, we can help mitigate that risk. We can message it properly and people can address it. Everything from not managing inventory properly, not taking inventory counts, having obsolete inventory, customers leaving, sales declining, or sales, let's take the opposite side. You're landing some, and most business owners will share this if they're landing big contracts, but that could also change the trajectory of the value of the business too. So surprises by far are the biggest deal killers, and that list could go on and on.
Oh, thank you so much.
Would you like me to go some examples or?
Yeah, I mean, 100%. If you got some examples, please share. Otherwise, I was going to say, hey, what questions do you have for us? That's kind of
sure. Well,
unique to our
real
podcast.
quick. I mean, over the years, we've seen a lot of different things, but like you mentioned earlier, there was one deal where it was right before we were going to market. They bought a $600,000 piece of equipment. They didn't need to buy it. They just wanted that newer piece of equipment. And this wasn't a business that was going to sell for $4 or $5 million. It was going to sell, in under that $1 million range. Well, that totally changed the view of because they're not going to get the multiple of cash flow plus 600,000 for this new piece of equipment. It just doesn't happen that way. But yeah, there's a laundry list of things. I think surprises are the biggest things. But let me I'll ask you a couple of questions here. Ben, on the banking side, what are some of the things that you're looking for when we bring you a deal or another business broker brings you a deal? What are the things that you're looking for?
I'm looking for ease of understanding the deal, right? Like I don't I think the thing that sometimes happens is like uh you get this overly complex spreadsheet with a wide variety of ad backs that don't have supporting detail behind them, and then the multiple of cash flows on the purchase price is based off of that, right? So it's like you look at that and you say, and you got a buyer, and you're like, does this buyer match up with this business? What is their ability to, is it indirect? Is it direct experience, right? So you're looking at all these pieces that have to come together to make the deal work. So cash flow is one of them, right? But it's understanding the cash flow, where the cash flow is coming from. If there are unique ad backs within the deal, what is the data behind that ad back? Um, on the buyer side, it's like, who is the buyer? What is their background? Can they step into this business and run it? Or if they can't, who is their leadership team? Um, is the purchase price in alignment with the cash flow, or are we using max multiple off of the most recent example, 2024 end of year financials, right? And then none of the other years cash flow. That's stuff like this. We talked about what kills deals. Communication is key, right? If you have a lack of communication right from the start, that's going to inhibit you all the way through the process. So what I see kills deals is incorrect structure on the front end. Um, so like the LOI will say a asset purchase, stock purchase, or membership purchase, but it's not defined. Well, the bank really needs to know what it is going into the deal, because uh, that they underwrite entirely to that structure. Um, Working capital is another big piece. So is there working capital being left in the deal? Because when that buyer takes over the company, they're going to have expenses on day one. So I, as a banker, need to know, um, is that working capital being provided by the seller? Is the buyer got additional post-close liquidity to support that working capital, or am I, as the bank, going to finance that working capital? If I'm financing the working capital, then the deal has to cash flow based on me financing the working capital. And I mean, by cash flow, it also needs to cash flow in a sense that the buyer needs to be able to take a livable wage out of the business, and be able uh to make a living off of this business, but also pay us back as well too. So those are some of the things. The other thing that I found helps move deals forward is letting the buy side team know at an early stage what the conditions are going to be of closing the loan. Uh, I've been doing this long enough to be able to look at a deal and know that I can get give the buyer a list of things that are going to be 90% within range of what that final closing checklist is. Buyers and sellers that really work towards uh, fulfilling those items, why we're in underwriting, really makes the difference in their deal moving forward. Buyers and sellers that pay attention to that list, it greatly increase their success rate of closing their deal.
Yeah, if they're not
I
getting the information to you, you can't get it to underwriting and you can't get it packaged in a loan commitment.
Can I
Right.
just add
So
this really quick here? I mean, this is so much value for free on a podcast. I mean, it's pretty amazing. So, Ben, continue.
yeah. So you cover that. One of the other things is, like, when I'm in underwriting, like, and I get questions out to the buyer. So what I try to do on the front end is try to get as many of those questions answered as possible. So I probably do a deeper dive into the deal than I would say uh, others. And I do that because I want to fully understand the deal. So when I'm writing my what I call credit memo, right? I'm literally going through kind of the key areas that I've learned early in my career, the 5 C's of credit, right? And writing my write up that way to focus on those, but also too, if there's weaknesses within the deal, deciding whether or not these are weaknesses that can be mitigated or these are really deal killing weaknesses, right? Like somebody that is maybe um, comes from, let's say, a IT background, right? And is going to step right into a manufacturer, right? How are they going to do that, right? How is it going to work? What are they going to do? Like, are they going to be operations focused? What happens if equipment breaks down? How do they deal with the customers, right? Are the
Yeah.
customers willing to work with that new buyer, right? Are the employees that are staying with the deal willing to work with that buyer? So I'm hitting on a lot, right? But
Exactly.
these are
One
the
thing that
kind of
you, or
go
go on, I'm
ahead.
sorry, Ben.
No,
One thing that you said
I've
before was messaging. And as brokers, I mean, this is one of the things that we really value in the banks that we work with, even if it's an early no. And one reason why we like working with you, Ben, is you go in there and you try to look at these problems or issues, and can we mitigate them? And if not, messaging that back to the brokers so that we can, one, maybe help keep the deal together, or and maybe sometimes it's a situation that this isn't the right buyer for that business, and it's time for that buyer to look at a different business that's a better fit or a better match. So we like hearing, and not that anybody likes hearing no, but I'd much rather hear no 10 days in as opposed to 70 days in, because now you just wasted 60 days of people's time. And so that's huge. And we appreciate that when we're working with you, Ben. Thank you.
Ben,
Do that.
I have a question for you. So how does working with like a good broker, or good brokers help you on your side? Because I know you kind of mentioned buy side, and we're going to talk more about buy side on next month's podcast. And we'll chat a little bit more about what is to come with that one. But, you know, sell side broker helping, message sell side to you. I mean, give us some insight as far as improving that process or how we can help you.
Yeah, absolutely. So I mean, when I'm focusing on who my referral sources are, right, I really focus on more the long-term rate relationship versus a transactional relationship. I'm like, is this person going to be someone I can work with in the long run? Do they care about the long-term success of the deal, or are they just in it and out, right? Like, um, the thing about it is like when you're working with a borrower, right? They are putting their self on the line, right? They're taking this big risk, and you have to you have to really think about it, right? Because like this is going to be the next 10 years of their life and maybe more, right? And so um, you want to make sure that they're in a position of success so that they continue to operate successfully. And also it protects the lender that you're working with as well too, because at the end of the day, um, you want to see uh, success. Now, not every deal is going to work out, right? But you want to make sure that like when you look at it that hey, you felt that you were putting this person in the best possible position and doing, looking at it that way because like and that's where I talk about the relationship, right? So your referral sources that you want to work with, you want to know that the deals that they're sending to you are good deals that have that
Yeah.
longevity, right? Because at the end of the
Mhm.
day, it's those things that I talked about, right? The long-term success of someone that, they are putting their livelihood on the line.
Yeah,
Right. I
you bring up
think
a really good point, Ben. having Matt with 17 years of banking experience before he came on to our team, he's able to work with our other team members in the finance director role to set the expectations of the seller and the other brokers on where will this deal get financed. And as I mentioned earlier on in the podcast, we don't take on every engagement. And that might be because maybe the seller wants this and they can only get financed to here. And there's two things going on: the value of the business and then what the business can be financed at. In the last couple of years, though, those always don't match up. So having Matt, why don't you just tell us, some of the things you do with the other team members on helping get the business in the right box, or maybe we tell the seller, let's just wait a little bit before we go to market.
So my main focus when I'm talking with another broker is really three things. I want to make sure that the seller gets the biggest bite of the apple, while a buyer can make an applicable investment in the business. They got to be able to get an ROI, right? Like Ben said, there's a wage there. They got to make a livelihood. And lastly, we got to make sure that that listing that's going live to market is eligible for SBA. So, all the things that we talk about maximizing value is going to translate into a transaction at some point, right? So you get your books right, you get all that stuff right. I'm going to go to that broker and I'm going to say, all right, walk me through this business. Why are they selling? Walk me through these financials. For the sellers on the line, the banks look at 3 years plus interims. So that's under a microscope. If you have a hiccup in 2023, as far as cash flow is concerned, we got to know why. And the question is does that increase or decrease your multiple? Does that increase or decrease the sell price, right? Because if you have discrepancies in cash flow over those years, it can greatly hinder the ability for that to go and be successful. Number one, if I see it and then I get it to the bank and Ben sees it, you bet your bottom dollar a buyer's going to see it, right? And all buyer counsel is going to see it. And as we start floating higher into cash flow, right, buyers are going to start asking for quality of earnings, right? We mentioned Squash CPA earlier, one of our sponsors, specializing in both buy side and sell side Q of E. But the banks can use those Q of E's to essentially solidify the financials. Yes, they're there. It makes sense. We understand it. But especially when we're looking at smaller transactions, understanding the discretionary earnings is crucial. I'm working on a transaction right now for a guy who funnels about $150,000 of expenses through 2 personal credit cards. That's tough, right? How do you identify what is a true quality of earnings, and does that really add into the right SDE to give us to the right multiple? I mean, you think 150,000 at a 3 multiple is $450,000 in value. So if you don't get that value right, I mean, the seller's leaving a lot of money on the table. The buyer maybe is getting a really good deal, and the bank's really happy because they got a 2-to-1 cash flow rate. So there's a healthy mix in looking at the deals, and especially when we represent sellers, to make sure that they're getting the maximization of the value of the company. And if they need to, unfortunately, go back out to market a year from now, 2 years from now, because they need to rectify some of those discrepancies in their books or some of those customer concentrations, or they need to clean up that inventory, that might be what needs to happen for them to hit their global goal. And, just general summary remarks here. For the sellers listening to this, we're happy to provide you with a free business valuation. Always reach out to us. We'll do that for you. But for the fiduciary contacts that are listening, our CPAs, our bankers, our lawyers, right? Helping your client get to the maximization of exit is just as much your responsibility as it is ours. So if your seller, your client is 63 years old and you're not having an exit planning conversation with them, it might be something you want to do this year. Mr. and Mrs. Seller, what does it look like? Are you going to sail off into the sunset? Or unfortunately, could you potentially die in the business? One of them is really good. The other one's going to suck, for your heirs and rolling something into an estate. So boy, we covered an awful lot on today's topic of maximizing seller value. And again, thank you so much for taking the time to share the insights over the last 20 years of what sellers can
Thanks,
do.
Ed.
Ben, it's always a great partnership looking at you and helping those sellers realize the dream of transacting. And as Tom said, we got some pretty exciting stuff coming up for future. So I'll leave the final
Yeah.
word with yourself.
Yeah, so next month it's all about buyers. If you like jumping into rabbit holes, this is going to be a deep one. We're going to go from start to finish, from looking in the mirror. Are you an actual buyer? Can you do this? Can you take this on or not? To financing, to analyzing deals, due diligence, closing, valuation, you name it. So it'll be just like this episode, packed with golden nuggets that I think are massive. I mean, we appreciate you, Ed. 20 years of experience. I've learned so much from you. I know we didn't, scratch the surface of what we could kind of get into today, but
Well, thanks for having me, guys. Appreciate it.
Oh, hey, and
uh,
as we finish it off, guys, I feel like the Philly cheesesteak dominated the brisket sandwich. Uh,
huh,
uh, and on Sunday.
It was a
was a
great, it was a,
domination.
Put
that
the
was a
timestamp on
domination.
this, Ben, with the Super Bowl.
Yeah.
All right, guys. Hey, if you like what you hear, follow and subscribe. We're going to be rolling out monthly, and we look forward to talking with you regarding your businesses down the road.